Good day, fellow investors. I really enjoy reading Barry's new Substack and the tragic algebra of stock-based compensation, but I want to expand that on the whole shareholder yield of the S&P 500, which is even more tragic at 1.9%. That's something that will not allow you to retire in the future. Because when it comes to investing, rewards to shareholders are from earnings through buybacks, dividends, reinvested in growth, and then Wall Street doesn't deduct it, but it is a huge expensive, and that is stock-based compensation that actually dilutes you or even eliminates profits in some situations. And even Warren Buffett discussed this his whole life. It is a compensation, an expense, and therefore not a gift from shareholders to management. But let's discuss the S&P 500 yield. This is a nice chart showing how at the current S&P 500 yield, it would take you 35 years to get your money back. And I don't get it, but it seems people don't care anymore. This is the average S&P 500 yield, dividend yield, that led to the historical stocks always give 10% per year. Not the current 1.14%, which is 1/3 of the historical. So you can expect maybe 1/3 of the historical returns from stocks just on that. Further, if we look at net income from Amazon, okay, 76 billion over the trailing 12 months. Cash flows much worse because they are investing everything into AI. However, the key here is stock-based compensation. And if we look at Amazon's shares, those have increased by 176 million over the last 12 months. If the goal is efficiently managing dilution, that means giving employees shares and buying them back on the market, that means that Amazon should spend 41 billion per year just to buy back the shares they are giving to shareholders. And if you look at 41 billion, that would lead to negative cash flows. That would be half of the net income to be spent more on buybacks that actually don't lower the number of shares outstanding. So if I look a little bit at this, Amazon net income per share $7. Burry argues that there is different valuations and different ways to see how this impacts, but let's just take a look. This is $7. Let's say Amazon grows at 8% per year, has a P ratio in 10 years of 20. The intrinsic value of the stock is 110. If I then look at things and say, okay, the number of shares will increase by 1% per year, then the number of shares goes up over time. That means that I have to lower the earnings in 10 years to calculate the terminal value by 10%, and that also lowers the terminal value here, Amazon stock in 10 years, at 285 to 260. Consequently, my intrinsic value just on the 1% stock-based compensation is 10% lower at 100, not at 110. Doesn't look that important here on Amazon, but Amazon is just one player. Burry mentions also Nvidia. So if we look at Nvidia, the stock did great, everything great. However, net income is 99 billion over the last 12 months. Stock-based compensation, accounting related, is just 6 billion. Then you say, okay, 6 billion compared to the 99, it's not that terrible. That should be okay. Cash from operations is good. However, if you look at the repurchases of the stock, 51 billion, 40 billion, 12, 11, and then if you look at the number of shares outstanding, actually shares went up. Therefore, all these billions spent didn't help the remaining shareholders, the pension funds, everybody in the world that now, if you are a passive investor, most of your money goes directly into Nvidia. What is it? 7% of the S&P 500, and therefore this is your retirement, your money. So no help there except for rewarding management that's likely selling shares. But okay, buybacks also push the stock higher, so nobody complains. But the cost is there. Half of net income is spent on buybacks and there's no reduction in shares. The expectation is that Nvidia will be profitable into eternity. Okay. That's something we could discuss, but that's again just another example there. There are other companies, and Nvidia even discussed this into their own documentation, their own memo, attacking Mr. Burry, how he wrongly looks at it, how he incorrectly included stock-based compensation taxes there, things like that, but still, potato, 112 for 91 billion, okay. The thing is that corporate doesn't care. Wall Street doesn't care. Buffett, Burry, Carlin care. But who cares? We can look then a little bit at Adobe. So they are focused on non-GAAP earnings, stock-based compensation, that's 25% lower. Further, if we look at the S&P 500 earnings, everything looks great, growth. S&P 500 earnings will go from the current 240 to 340 in just the next less than 3 years. So that's 33% up growth in less than 3 years. Then I go to SP Global, the S&P 500 earnings estimate report, and I look at the last 12 months, the actuals that we have for 2025. S&P 500's earnings are 2022. Let me just show you again, 2022 to 348 for 14% growth, everything great. Nobody cares about stock-based compensation, dilution, things like that. That's for boring nerds like you, Sven or Michael Burry. However, let me show you something else. I'm going to the Guide to the Markets, JP Morgan, 2022. I look at the consensus Wall Street analyst estimates for 2024. Here we are at 260 for 2024. I look at 2024. Real S&P 500 earnings is 210. 210, this is the discrepancy between what Wall Street is telling you and projecting and reality. That's a significant discrepancy to think about. That's not 1% per year, that's 20-25% of your pension retirement funds. Something to think about. Then, if we look from Yardeni, great charts there, S&P 500 buybacks and dividends, around 1.5 trillion, the last data we have. A little bit less than 1 trillion is for buybacks, and around a little bit less than 700 billion is for dividends. But the key, stock-based compensation is growing at 10% annually. That is insane. So, of course, management is going to reward itself. The more, the merrier, especially now with passive investors. No opinion, just investing depending on market capitalization. Thus, you push your stock higher, the higher the market cap is. The higher the market cap is, the more you spend money on buybacks. The higher the stock price is, the more money you make when you sell those shares on the market. Market cap, the more shares there are, the higher is the market cap. So it gets this crazy incentive that doesn't really reward true long-term shareholders. All in all, when we come to the S&P 500, 1.6 trillion cash is spent on buybacks and dividends. If you look at the S&P market capitalization, 1.6 trillion, 57.5 trillion is the complete market capitalization, you would say the S&P 500 has a yield of 2.7%. Give it a few percentage points growth and you will get your 6% over time, inflation, 6, 7, 8%, right? Well, not that fast. we have buybacks, yes, but a quarter of that is just to compensate for stock-based compensation. That means that of the trillion, I'm already taking away 250 billion that's simply diluted. So that's already lower. Again, to quote Buffett, when the share count goes down, your interest in our many businesses goes up. Every small bit helps if repurchases are made at value accretive prices. Just as surely, when a company overpays for repurchases, the continuous shareholders use. At such times, gains flow only to the selling shareholders, the management, and to the friendly but expensive investment banker who recommends the foolish purchases. If we look at Berkshire on our quadrant, Berkshire stopped doing repurchases since it was here, giving 6-7%. Now it doesn't do. But the whole of the S&P 500, the higher the S&P 500 goes, the more money they spend on repurchases. Now, we have already lost the share-based compensation money. Then what if in the index, and you cannot argue with me, if you're a passive investor, you invest in the good, in the bad, right? The good will go higher, the bad will disappear. So let's say that 50% of the S&P 500 repurchases now are bad repurchases. Because if the company disappears in 5 to 10 years, no point in your repurchases. 50%, I don't think anyone can argue there. And here I'm being very, 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 very mild. To be honest, I would say 90% of current S&P 500 repurchases are a waste of your pension fund money. But guess what? You have no say in it, even if it's your money. So if I deduct the 250 and just be kind there and deduct another 250 billion because wasted repurchases, I'm back to 1.1 trillion yield, shareholder yield for the S&P 500 shareholder, which gives me a 1.9% shareholder yield for the S&P 500. And that could be even lower. 1.9%, but Wall Street, the friendly investment banker, as Warren Buffett calls, says this will grow forever into eternity. Great numbers, so the yield doesn't matter because this will grow forever. I don't know. Berkshire has 382 billion in cash. In this video I told you, if that doesn't slap you enough, I don't know what will. Tesla, dilution with the trillion Musk package. If he just deliver robots or calculators or whatever, you will see more dilution. And then his brother selling constantly, Musk is selling constantly. So, as Burry says here, as an aside, Elon's cult was all in on electric cars until competition showed up, then all in on autonomous driving until competition showed up, and now all in on robots, of course, until. But then again, you see here, roughly 80% of Nvidia employers are now millionaires. That's the value created there. However, Buffett prefers the 3.7 treasury yield and weighting than the 1.9 and money destruction, buyback, stock-based compensation, dilution. Now, next to discuss, Michael Burry predicts a very bad market ahead, which we have just discussed here, the yield. We can discuss more on that on Barry's video. I'll make then a video on what could really make this passive mania into the S&P 500 revert, and that will be the focus for those two videos on the market. Of course, check my quadrant update platform and other stock analysis video that we do on this channel. I'll see you in the next video.